Hello and welcome back. In the last two episodes, we covered lease versus purchase from two perspectives. One was the net present value, and the second one was the internal rate of return of the difference or the differential. And this was strictly from a financial point of view. So what we covered for both methods was whether we should purchase or lease and nothing else. And this is all black and white. However, life is not black or white. It's about negotiations. So the question is, if we were going to purchase it or if we were going to lease it, what is the price that we should purchase it at? Not whether we should just lease it or purchase it. In real life, if you think something is going to be worth a lot more in the future, then you're probably a lot more likely to pay a much higher price for it. In this segment, we will look at the sales price where the cost of owning and the cost of leasing would be the same. This is basically our break-even point, and we will also figure out a growth rate to get to this break-even point. This allows us to compare this growth rate with the market growth rate and figure out whether it's worth doing this or not. I am your host, Brian Shakaremi, and let's get started. In this segment, we are going to touch base on the sale price point of indifference or the break-even point. So the question is back, should I buy it or should I lease it? However, in this session, we will add an extra kink into this. If I were to buy it, at what price should I buy it versus leasing it? After all, that is a real life issue. It's a real life question. What if your business is expanding and you need a new building? What if you're just starting your business and you need a building? And then the question comes up, should I buy it or should I lease it? How about if you already had a building in mind and you're wondering what the right price for it is versus leasing? Up to now, we have covered two methods of finding out whether we should buy it or lease it. The net present value or the IRR, internal rate of return of the difference. So we've been able to determine whether to buy or lease. However, we have not determined at what price we should be buying it at. So what if before we bought the place, we could find out a sale price where the cost or present value of the purchase equaled the cost or the present value of leasing? So what am I talking about and how would it behoove me to find this sale price? The sale price where the net present value of leasing equals the net present value of owning is called the sale price point of indifference. Another word for it could be the break-even point. What does it mean to me? It really means at that sale price point of indifference, the price of owning or the cost of owning equals the cost of leasing. You take your pick. So once again, at the sale price point of indifference or the break-even point, the cost of owning equals the cost of leasing. So what? How does it help me? How could it benefit me? Well, it means that if you believe or have any inclination that you could sell the property for a higher price than the sale price point of indifference or your break-even point, you should definitely buy and own the property. This may happen if you perhaps have some knowledge of future zoning changes, or perhaps you know of some new construction of a new mall or a major shopping center, or perhaps a new interstate or major highway that would be developing around your building or the proposed building. This would by all means increase the price of sale and give it a much higher value. Conversely, if you thought that your property would sell for a lower price than this sale price point of indifference or your break-even point, then you should lease the property. And hopefully I've said enough to where you would like to find out more. I've always said knowledge is power. So once you know this sale price point of indifference or your break-even point, Then you can figure out what growth rate it takes to reach this sale price point of indifference. So then what you do is you compare the market growth rate to this growth rate that you calculated for your building. And this will also be a very good determinant of whether you should purchase it or lease it. The question is, will your property at a minimum grow at this rate, the market rate? So again, perhaps you know something that others don't, i.e. zoning changes, i.e. a large shopping center developing around your building, i.e. a new interstate or major highway developing around your building. And here's how you go about it. We are doing this strictly from a financial point of view. And any worthy financial analysis requires a cash flow analysis because cash flow is king. So far, it's very simple. As in segment 1 of lease versus purchase, we find the net present value of owning and the net present value of leasing. For owning, we have the initial investment followed by the cash flows from years 1 through year N, or however many number of years we are planning to hold the building, and we add the sale proceeds to it. And using our weighted average cost of capital or the discount rate, we can easily calculate the NPV or the net present value. For the leasing cost here to the right, we start with the lease payments from years 1 through year N, or however many number of years we intend to keep the building as a lease, and we subtract the associated tax savings from them. And that's based on the tax bracket. Once we have this, we can easily then, like the owning side, calculate the net present value using either the weighted average cost of capital or the discount rate. Remember that the net present value is made up of several things. The first thing is the initial investment or the purchase or down payment of the purchase. The second thing is all the cash flows associated with it from years 1 through however many number of years we intend to hold the building. And finally, we have to add the sale price. So there are at least 3 components to the net present value. However, the first 2 items, the initial investment and the cash flows, we can't really change or we can't really play with. However, it's possible to change the sale price. And if you change the sale price, lo and behold, you change the net present value. So again, any change in sale price changes the net present value. If your net present value of owning equals the net present value of leasing, then you are at the sale price point of indifference or the break-even point. Take your pick. You're home already. However, if your net present value of owning is greater than the net present value of leasing, then to equalize the two, you have to reduce the net present value of owning. And how you do that is through reducing the sale price. If you reduce the sale price, it affects the net present value of owning. It decreases or reduces the net present value of owning. Conversely, if the net present value of owning is less than the net present value of leasing, then to make them equal, you have to increase the net present value of owning. How you could do that again is through the sale price. If you increase the sale price, then you increase the net present value of owning. It's all good so far, but there's a problem here. If you're going to raise or lower the sale price to equalize the 2 net present values, how much do you raise it by or lower it by? The answer is simple. It's by the net present value of the differential, which means the net present value of the difference between owning and leasing. But what's the problem with this one? As you know, the PV and the NPV stands for the present value. And you can't add or subtract a present value to sale. Sale is something that takes place in the future. The solution is simple. We have to find the future value of this net present value of the differential, coinciding with the time of sale. And depending on our situation, we either add or subtract this future value from the sale price. So let's do a little recap. To find the NPV of the differential, we subtract the NPV of leasing from the NPV of owning. So you can say that the NPV of the differential is the difference between owning and leasing. Once we have this differential, if this number is positive, then owning is worth more. The net present value of owning is higher or larger than the net present value of leasing. To equalize the net present value of owning and leasing, we have to reduce the net present value of owning. Therefore, we have to lower the sale price or adjust it downward. How much do we reduce it or adjust it downward by? That's done by the projected or future value of this differential. Conversely, if this difference was a negative number, it signifies that the net present value of owning is less than the net present value of leasing. To equalize the two, we have to increase or raise the net present value of owning. To do this, we must raise the sale price by the projected future value of this differential. So to recap, the sale price point of indifference or the break-even point is the sale price plus or minus, depending on the situation, of the future value or the net present value of the differential. Is the sale price adjusted up or down by the future value of the net present value of the differential? We have another problem here. Just on what basis are you projecting into the future this net present value of the differential? The answer to that is also very simple. It is projected using your discount rate or the weighted average cost of capital, or your WACC. Knowledge is power. Now you know your sale price point of indifference. So far, we've done a lot of explanation on this topic. So as always, let's drive our point home with an example. Our example starts with a new building that our president may want to acquire. Trump Enterprises is looking at a commercial building for its winery business. Tinery or Trump Winery or Tinery Plaza. Mr. Trump is trying to figure out whether he should buy it or lease it. He has both options on the table. The whole time, if he were to acquire the building, would be 20 years, and it would be the same if he were to lease the building. There is financing involved, and you're tasked to provide a recommendation to Mr. Trump as to whether he should lease it or purchase it, and the wrong answer will get you fired. Below is the information provided for our analysis, starting with the building size, holding period, purchase price, acquisition cost, improvement allocation, which is used for the cost recovery recapture, the annual growth rate, this is to calculate the disposition or sale price, and the projected cost of sale at disposition. Below it is the user information on Trump Enterprises, their associated tax brackets, and the discount rate or weighted average cost of capital. To the right is the financing information. The loan-to-value ratio is 80%. Interest rate or the discount rate is 7%. Amortization is 20 years and the loan term is 20 years. This is a self-amortizing loan. Below that is the lease information, and the lease term is 20 years, and the rent information per square foot. Notice that there are 1, 2, 3 bumps or escalations in the rent. From years 6 through 10, another escalation from years 11 through 15, followed by another one from years 16 through 20. We start with our lease cost, and we'll calculate the net present value of our lease costs by finding out what the cash flows are before tax for each year from years 1 through 20, and we subtract the associated tax savings, which is based on the bracket, and lo and behold, we come up with the cash flow after tax. Once we have that, it would be easy for us to find the net present value using the discount rate or the weighted average cost of capital. And we come up with the same thing, meaning the net present value of the purchase cost using its after-tax cash flows, which starts with the initial investment, followed by the cash flows for 20 years, and followed by the sale price. Using this, it is very easy to determine the net present value, of course, at the discount rate or weighted average cost of capital. Notice that the net present value of owning is greater than the net present value of leasing here. So what do? As we discussed before, if the net present value of owning is greater than the net present value of leasing, to equalize the cost, we must lower the sale price by the future adjusted differential amount. The differential amount, the NPV of the differential, happens to be $751,315. So we have to project this number into the future and subtract it from the sale price. Our NPV of differential projected 20 years into the future using a 7% weighted average cost of capital happens to work out to $916,747. This is the number that the sale price must be reduced by. So here again, we take this future value of the differential and we subtract it from the sale price to come up with our sale price point of indifference or the break-even point. But wait a second here. Where's the tax and the cost of sale in all of this? You cannot purchase or sell anything, at least in the United States of America, without paying the taxes and the associated sale costs. So you have to account for it and you have to adjust for it. So first, we have to adjust it for tax costs. And second, we take that number that was adjusted for tax and we readjust it for cost of sale. As a reminder, the future value of this differential was $916,747, which must be adjusted for tax and cost of sale. This number adjusted for a 21% tax rate comes out to $1,116,439. Now we take this adjusted number and we adjust the same for a 2% cost of sale. So lo and behold, the future value of the net present value of the differential equals to $1,184,122. This is the amount that must be subtracted from the sale price to reach the sale price point of indifference. Remember, our sale price was calculated to be $48,808,000 based on a 1% growth rate. Therefore, we take the sale price and we lower it, we reduce it by the future value of the net present value of the differential adjusted for taxes and the cost of sale. And this will give us the sale price point of indifference or the break-even point. Rounded to the nearest 1,000, we have $47,624,000. So then we'd want to know what kind of growth rate would take us from the purchase price of $40 million 20 years down the road to a sale price point of indifference of $47,624,000. This is easy to calculate as we have the present value, we have the future value, we have the number of years, and we're looking for that I or the interest rate. And that happens to work out to 0.88%, which is less than 1%. So now we either calculate the market growth rate or we obtain it from an authoritative source. If we have to calculate it, we have to do projections using economic-based analysis or economic-based multipliers, which is a subject of discussion for another episode. And for example, if your market analysis shows a growth rate of 1%, that means your building, the one that you're looking at, didn't even grow as much as the market. In this case, you advise Mr. Trump to lease the building instead of purchasing it. And if your market growth rate was 0.5%, but your building growth rate was 0.88%, well, then you're higher than the market rate and you would advise Mr. Trump to buy the building. And this will prevent you from getting fired. So to recap, we just covered lease versus purchase. We also covered the sale price point of indifference or the break-even point. And we covered the necessary growth rate to reach this sale price point of indifference. As always, if you have any questions regarding what we just discussed, please send me an email to the following link and I would be happy to get back to you. Thank you for your time.